everyone, a very good evening and welcome to a special show today on The Money Show. This is our tax special. I'm Avan Dabash. Joining in over the next 30 minutes, we have with us Parizad Sirwalla, partner and head Global Mobility Services, tax at KPMG. She'll be guiding us and giving us all of the latest recommendations as well as her expert advice on weaving your way through the overall ambit of tax. And I'm going to start off, Parizad, with an interesting quote by Albert Einstein. In fact, he said, the hardest thing in the world is to understand is the income tax. But of course, you're an expert at that. And let's try to simplify things for most of our viewers in order to help them out. So we'll begin with some discussion topics as well. And the first one that I'd like to talk about is the importance of filing of tax returns and forms. What exactly is, let's say the thumb rule or the checklist of forms that are required, and of course the importance of doing this on time, if you could clarify.
Sure, Avan. So, you started with a quote, and I would like to start with a phrase that there are only two things certain in life, and that is debt and taxes. So there's really no escape from, your tax filing requirements. For those of you who are familiar and, with the working of this current government, compliances and disclosures and tax filings and statutory compliances is at an all-time high, and it's of paramount significance now. Gone are the days where individual taxpayers perhaps thought that, by not filing returns on time or claiming excessive deductions and not really breaching the taxable income limits was okay to do so. But I want to start with a slight word of caution to say that the income tax regulators are now, they have data at the click of a button. India, as you know, is on the cusp of digitalization. There is automatic sharing of information between various companies. So tax compliance is really of, assumed even more importance and gravity as far as the tone at the top is concerned. Coming to your question, yes, there are statutory deadlines. As an example, for individual salaried taxpayers, every year by 31st July, we need to file our tax returns. There are a plethora of forms available. There are a plethora of prescribed forms. One needs to really see what is the stream of income, and you have forms ranging from ITR 1, 2, 3, 4. You can see it on the website as well, but generally it depends. If you have salary income, whether you have house property income, dividend, capital gains, wherever your stream of income is, you need to really fill the right form. So there's a checklist and a table of forms that are available.
Okay, so that's starting off with the basics, if you will, giving us a sense as to what exactly is needed when you're filing your tax return forms. Well, we've got a whole host of viewer queries as well, Parizad, so let's get straight to it. We first have an email query which has been sent in to us from Malvika Anil. She says, I'm 27 years old and I haven't done any tax planning yet. My only tax saving is in the form of the mandatory PF contribution. What other tools, she asks, can I use to reduce my tax, such as utilizing Section 80C or investing via NPS? And I find, Parizad, and I'm sure as you will as well, that a lot of people out there haven't done too much tax planning, especially if they're younger, and the mandatory PF contribution that they're made to do is the only resort that they have. What would you encourage them? What message would you want to send to them? And of course, specifically for Malvika, what are the other options that she has in order to claim deductions?
I presume that Malvika in this case is a salaried individual, and I would like to start with first with that presumption. If she's a salaried individual, then as per her employer's policies, there could be a couple of perquisites and amenities that she can structure her salary, of course within her employer's framework that is possible. And there are certain, items like house rent allowance, car lease policies, telephones, meal reimbursements, etc. That can be LTA, that can be structured more as, a flexi benefit comp, and certain exemptions are prescribed in the law legally to optimize on taxes. So that is one avenue open to her to explore. which she can, break up her costs to the employer in these tax efficient items. Over and above that, you mentioned ATC is a actually very crowded limit of tax exemption provided annually to the tune of, rupees 1,50,000 per annum. Now, within that, there are a bundle of expenditure and payments that are sort of all clubbed together, and the maximum an individual can claim is around 1,50,000 per annum. Some of the items in case, so she should really see, if a provident fund, a PPF is sufficient and, breaches the 1.50 lakh limit, because there are other items also like LIC payment, education expenses, housing loan if she has repayment, items like this which can also be a part of that 1,50,000. So the first step would also be to see whether she's really availing this deduction to its fullest extent possible. If she's keen on investing in certain pension retirement products, then you have the NPS scheme, which is every year being popularized by the pension regulator. Because if one has investments in the NPS, then there is an additional deduction of 50,000, which is also available over and above the ATC 1.50 lakh limit, which means that if I as an individual invest in NPS along with my PFs and PPFs, my total tax deduction annually can go up to 2 lakh rupees per annum vis-a-vis the 1,50,000. Over and above that, there are few and far items. If she has bank interest, savings bank interest, which all of us have, then there is a deduction of 10,000 annually, which is also prescribed. I mean, at this stage, I can think of these avenues that are open for her to be utilized to its fullest potential.
All right. I hope you taken note, Malvika, as to what are the other options that you are eligible for, and what exactly else you can do. And of course, this all depends on your company's policies. You can look to claim a lot of other exemptions. Let's shift gears to our next query for the day, and this one comes in to us via email from Mr. Bhojwani. And I encourage all of our viewers watching as well, if you have any questions, if it's tax related, you can email us on themoneyshow@etnow.tv. We can try and take it up today or next week on Tuesday on our tax special. Our phone lines as well are open. Well, Mr. Bhojwani asks, what exactly is a grandfathering clause for equity mutual funds? And I find time after this news has been announced, it's been months now, but there's still a little bit of clarity that's required, and everyone is a little bit concerned as to what happens to mutual fund investments. So clear the air for us, Parizad, and explain the overall amended norms of LTCG with respect to listed equity shares as well as mutual funds.
Right. So, first, what was the position till 31st March 2018, and what is exactly this change that everyone is talking about with effect from 1st April 2018? So, prior to 1st April 2018, any sale of equity shares or equity-oriented mutual funds was exempt from taxation. With effect from 1st April 2018, in the last budget, there was a change to this exemption provision, which stipulated that any long-term capital gains, and generally the period of holding for equity assets to be classified as long-term is a period of 12 months. So if you're selling off any equity asset, whether it's a listed share or an equity-oriented mutual fund, which is classified as long-term, after 1st April 2018, and those gains are in excess of 1 lakh, then the said amounts now are taxable at the rate of 10%, which were earlier tax-free. So for those of us who are investing in the capital market, this is a big change. However, with an aspect of giving relief to existing investors, there is a grandfathering provision coded in the tax law, which basically insulates, or very generally put, exempts your gains up to 31st of Jan 2018. So the incremental from that date is, to put it very simply, taxable, and not the full gains between the sales price and the cost price. So to that effect, the sort of harshness of the tax is offsetted by this grandfathering clause, which is basically meant to exempt all your accrued gains up to 31st Jan 2018, and that is what this famous grandfathering clause is all about. Dividends from equity oriented funds or any mutual fund, whether debt and equity, continue to be exempt. It's only the long term capital gains that is sort of the taxation regime has changed.
All right. I hope that finally clears the air, Mr. Bhojwani. Thanks very much for sending us your queries. So clearly that applies only gains post 31st January 2018 shall be liable to the tax is essentially the point that Parizad is driving home. Well, let's get in some live callers as well. We have Mr. Ramakrishna Das. He's joining in with us on the phone line from Assam. Welcome to the Money Show, sir. What's your question? Do we have Mr. Das on the phone line? Oh, I think we've unfortunately snapped that line. We will be reconnecting with you after this very short break. Tell you what, let's take a quick breather. Stay with us on the other side. Parizad Sirwalla will be with us answering all your questions and queries related to tax, as well as we'll be talking about the increasing focus on compliance and rise in assessments. What is the outlook on that? Come right back and find out. Great to have you back with us. This is the Money Show. It's our tax special, and guiding us over the last 15 minutes and the rest of the show is Parizad Sirwalla, partner and head Global Mobility Services at Tax at KPMG. We're taking on your live calls as well. There's a number flashing at the top of your screens. If you want the right advice, you can call in, or you can simply email us your question on themoneyshow@etnow.tv. Well, we've discussed quite a number of topics. Talk about filing of tax returns. We've also talked about utilizing Section 80C or NPS for those who haven't explored any other tax planning alternatives, as well as the grandfathering clause in equity mutual funds. Time now to discuss another topic, and with the IT department tightening its noose, increasing focus on compliance and rise in assessments, how is it that individuals really need to, up their game and Parizad, give us a sense as to what now the situation is in India versus what it was a few years ago.
As I said before, Avan, the trust is clearly on, getting as many disclosures of income and assets as possible in our statutory income tax filings. And clearly as we see the trends, not all returns are audited by the regulators, but there is an increasing trend of, assessing the returns and verifying the completeness and accuracy thereof. As an example, a few years back, 3 to 4 years back, you would not really have a sort of a balance sheet disclosure in the income tax prescribed forms. The last couple of years has witnessed an increasing spate of disclosures specified in terms of schedules in the statutory income tax return form. As an example, if you're an ordinary resident of India, then you have the obligation to disclose in various schedules of your return form, not just your Indian assets, but also your overseas assets. So one part is the income taxation of it, which was always there, and you're liable to pay the taxes on your income. But there is an added disclosure of disclosing all your assets, even if they are unproductive. As an example, if you're an ordinary resident, as I said, if you have overseas bank accounts, overseas assets, whether house property or any other assets, there are schedules prescribed for disclosing it, and there are the values at which you disclose it also coded. Similarly, Indian assets, there are schedules. If your income exceeds a particular threshold, 50 lakhs, you have to disclose all your loans and advances, your jewelry, your cash in hand, and your bank balances. So basically, it's a balance sheet approach with a complete focus on enough compliances and disclosures in the statutory return form as well, which was not there earlier. So along with your income streams and your tax on your income, you need to spend some time collating the exact list of your assets and disclosing the same in the return form.
All right. I hope a lot of our viewers have also taken note, because as Parizad said, we have definitely seen a lot of, more surge in notices and inquiries from the Income Tax Department. But let's move on to more queries and questions that you've sent in. And as I said, if you want to reach out to us, there's a phone line which is open. It's free tax advice. Well, we've got Neelu Valecha who has emailed us saying, my husband has purchased a flat in my name. He has taken a housing loan in order to finance that purchase. Will he be able to avail income tax benefits? An interesting question. When you purchase a flat in your name, are there any income tax benefits that you can avail of, Parizad?
Yeah, so in this, generally ownership of an asset from an income tax perspective is basically translated as to who funds the asset. So in this case, I do assume that the husband has purchased the flat with his funds and basically put the wife's name on the title deed. There are basically two large or prescribed exemptions or deductions. If the flat was taken on mortgage, then the husband can claim around up to 2 lakhs of interest payment done on the mortgage as a deduction. And as we discussed earlier, the ATC limit, which though a crowded limit of 1,50,000 for a host of expenses, repayment of principal housing loan is also one element therein. So if he has not fully utilized the ATC 1,50,000 limit with the other avenues of payments and expenditure, he can also avail that for the housing loan principal repayment, and also if the flat is on mortgage, on the interest. It's always better to get a full interest certificate from the bank evidencing the amount of interest paid on the loan throughout the year. And one also needs to be careful whether it is a co-ownership of property, whose funds are these to establish who the owner is. Because of late there are also certain judicial precedents prevailing which have got into this ownership of the asset. But by and large, if the husband has funded, he should be able to avail these two deductions.
All right, there you have it. Those are some of the steps that you can resort to in order to avail income tax benefits. Well, we have managed to reconnect with the live caller. Ramakrishna Das is with us on the phone line from Assam with his question. Welcome to the show and tell us, what's your query?
Madam.
Hi, Mr. Das. We can hear you clearly. Good evening. What is your question?
Good evening. Oh, my question is that I am a teacher and I filed. My name is Ramakrishna Das from Kolingnath, Assam. I am a teacher and I file e-filing, TDS e-filing of every quarter. But is it mandatory for me to filing return only?
You said
I quarterly filed TDS e-filing for NSDL. Is it mandatory for me to file return again?
Okay. You said that you have filed your TDS returns, am I correct?
Quarterly.
Quarterly. And now you are asking, is it mandatory to file?
Return. IT return.
IT returns. Okay. Is this for any specific period that you're talking about? Parizad, let me take it to you. Would you like to question him on anything else? Are you clear with the query? Yeah, go ahead.
Yeah, Mr. Das, let me understand your question because I'm not very clear with the nature of your query. As I understood, you have, the quarterly e-filing for TDS returns is generally for payers of income. So if you made certain payments to someone which were subject to tax deduction at source, then that typically gets, e-filed by way of an e-TDS return. The obligation to file your income, and I would really need to know what the nature of the TDS that you've deducted, because it's generally filed by the payer of the income, as I mentioned. Your individual income tax return is, depending on whether you are having any income above the thresholds, specified, and it depends on what you are. I mean, are you a salaried employee? Are you receiving any income from other sources? That would decide your obligation to file income tax returns. I'm not very clear with what you have filed as ETDS returns. The two could be possibly related and unrelated as well. Your obligation to file your income tax return is on the income you receive and the quantum of it. Your TDS filings, you may have done, I don't know, some rent payments to someone which was subject to TDS. Those would come under the purview of the quarterly filings. But we'll need to have more clarity on this, Awam, before I can address it accurately.
Totally understand. I suggest, Mr. Das, you take down our email address. That's themoneyshow@etnow.tv. Send us a more detailed question and we promise to take it up on our tax special next week. That's going to be on Tuesday. In the meantime, we've got another email query and this one has been sent in to us from Dhanraj Ajmera. He says, I made capital gains of about 1 crore from the sale of property in FY18. In the same year, I invested 50 lakh rupees in infrastructure bonds to save capital gains tax. Is it advisable again to invest the remaining 50 lakhs in infrastructure bonds in this fiscal year in order to save tax? So what is really the linkage when it comes to infrastructure bonds and saving of tax, and what is the advice that you have for Mr. Ajmera?
So there's something called a rollover relief in the income tax provisions that basically for long-term capital gains incurred on sale of certain assets, in this case property, to be able to exempt a portion of this long-term capital gains, there are certain avenues provided, one of which is this investment in specified bonds. The threshold limit is 50 lakhs and you can't really say that I will do 50 lakhs in one tax year and 50 lakhs in another and take the exemption up to 1 crore. The limit of 50 lakhs is linked qua sale of the asset. So you will get the exemption from the first of all, the sale has to be classified as a long-term capital gain. And in this case, property is being sold. So you can clearly invest maximum up to 50 lakhs in these bonds. Okay, and that's the maximum ceiling qua the sale of this property.
Okay, I hope you've taken note. The maximum exemption that one can avail is about 50 lakh rupees. If you want to send us a more detailed question, feel free to do so. Next up, we have a question or query sent in to us from Mr. Behram Dinshaw. He says, I'm retired and draw pension from EPFO and my former employer via LIC pension unit and LIC's Jeevan Suraksha policy. Will this income be taxable? Can I claim the 40,000 standard deduction? What is your advice when it comes to the EPFO, the employer pension scheme? And what is the overall eligibility for our viewer here?
So any pension received from the employer is fairly clear. It's taxable as salary income and you can avail a 40,000 rupees of annual standard deduction against the same. Any receipt of pension which is non-employer based, so in this case the LIC Jeevan Suraksha policy that he receives from, is taxable under the head income from other sources. There is no standard deduction available. It's only against salary related pensions. The question then remains for any pension that an individual receives from the EPFO, so let's say someone who's invested in the NPS scheme, there is a slight bit of ambiguity. It is of course taxable. There's a slight bit of ambiguity and two schools of thought prevailing, whether the EPFO pension falls as salary related income or income from other sources. It's clearly taxable. The only moot question is whether you get the deduction of 40,000 against the EPFO pension. It's not really free from doubt. The rest two are very clear. The employer LIC is, clearly salary income. And you can offset 40,000. The Sukanya scheme that you spoke about is non-employer related, taxable with no standard deduction possible.
All right, Parizad, then before we let you go, just want to read out her tip for the day. Good news, as she says that dividends, but it's of course a known fact, dividends from Indian mutual funds continue to remain exempted from tax. Parizad, pleasure having you with us on the show. Thanks so much for joining in on the Money Show, the tax special. With that, it's a wrap, and thanks to all of our viewers for watching.